liquidity, a sense in the investment community of the strength of the US economy. Um, I think it's a similar sort of trend that you get towards the end of a cycle. I suspect that that cycle has ended and that we're going to go into 6 to 9 months of falling equity and commodity markets. I think that
Brace yourselves because what you're about to hear might just change how you see the future. Simon Hunt, a renowned global strategist, has a bold and shocking forecast for gold in 2025. Are you ready for skyrocketing prices, an economic upheaval, and the ultimate role of gold in reshaping the financial world? This is not just another prediction. This is your wake-up call. Let's dive into what's coming and how you can be prepared.
what changed was the hawkish tone that Powell introduced in his Q&A session. And it started, the markets have been overbought, overvalued. It only needed a small trigger, and that was the trigger. And I think this is what will come from that trigger will be over the 6 to 9 months, so not day to day, but over the next 6 to 9 months, you'll see, for instance, the S&P falling by about 20%, the FANGs by about 40%, and that then lays the foundations for the next big move up, which will take us into 2027, and then we see the collapse. It's I mean, what we have seen has only been the low-hanging fruit that have gone into failures or bankruptcies. For the bigger fruit, it takes longer for them to fail because they have other options, other funding options. It's only when those funding options are exhausted do they fail. And it's maybe that's what he's seeing in the undergrowth of the financial system. To come back to how I started, that's why we have these 3 short-term cycles until we get into 2028, when then we enter rolling recessions, if not depression, and it's wartime, consolidation, no growth. I think the other BRICS countries will use 25 to consolidate, start building up their own secretariats, start, instead of the new development bank, which is the BRICS bank, which have been making their loans in dollars, start making them in local currencies. So really, it's a time to consolidate, build up our own internal infrastructures, not a time to expand. Liquidity, a sense in the investment community of the strength of the US economy. I think it's a similar sort of trend that you get towards the end of a cycle. I suspect that that cycle has ended and that we're going to go into 6 to 9 months of falling equity and commodity markets. I think that when the revised employment data comes out, people are going to be shocked that actually employment fell last year. When you look at retail sales in nominal numbers last year, up to the first 11 months, they rose by 2.4%. But what did CPI do? Rose by 3%. So even assuming, even taking CPI, then you had negative retail sales last year. The problem is that CPI is thoroughly manipulated. You talk to any household, the wife who does the weekly or the monthly shopping will tell you inflation is very much higher than that. if you use the unmanipulated data going back to the 1970s that John Williams of Shadow Government Stats does, inflation this year so far has averaged 10.8%. So, I mean, even saying that the figure is 5%, that's a pretty big drop on retail sales. And we'll probably see retail sales in the early months of next year being revised down. So there are all sorts of complications to the economic data. But I think there is two other matters that we need to address. The first is that the revisions in the employment data will be produced by the BLS in February, and that is bound to show a very sharp revision downwards. And since the Philly Fed does a regular assessment of the employment data themselves, and not so long ago, they came out with a revised figure for the year ending March this year. And when the BLS revised their data, it was absolutely smack on, 800,000 down. They are now saying for the second quarter that employment fell, whereas the BLS is saying rose by 1.1%. So the economic chips that we will see in the first 6 to 9 months of next year are not going to be good. But there is another element, and an important one, which is that, I'm just getting my notes, which is that there's probably going to be a deliberate policy by the Trump government to take a lot of the fat out of the economy in order to have a sounder base from which they can grow the economy and grow prosperity. For instance, Elon Musk on the 29th of October said, "We have to reduce spending to live within our means, and that necessarily involves some temporary hardship, but will ensure long-term prosperity." So we've got to have a solid base before we can produce the better things for everybody. So on our cycle work, we will see a weak global economy in the first 6 to 9 months of next year, by when the fiscal and monetary stimuli, which Trump and others will introduce, will start a 2-year boom in equities, in business activity, and in commodity markets. But the problem is that it will be accompanied by rising inflation. And what we see as we go through 2027 and into 2028, we will see a repeat of the inflation process that we experienced in the late 1970s and early 1980s. And what does that imply? If US CPI is around 13% and global inflation around 15%, what are long-term bonds going to yield? US 10-year treasuries will be yielding over 10%. What is that going to do to a highly leveraged debt system? It's going to be the end of this particular cycle, and we go into rolling recessions or even depression. So how does the frictions or the wars being seen in Europe and the Middle East, how do they fit into the scenario? It's very possible that the Trump administration who are who don't want wars will do what they can to prevent the wars from escalating.
Thanks for watching. If Simon Hunt's bold forecast got you thinking, don't forget to hit that like button and subscribe for more eye-opening insights. Let us know your thoughts in the comments. Are you ready for what's coming in 2025? Stay tuned for more updates, and as always, stay informed, stay prepared, and stay ahead.